My name is Shannon Rendell. I'm on the investor relations team for Lombard ODA in New York. I'm thrilled to be joined today by two thought leaders in sustainable investing, Arnaud Langlois and Juliette Menga, who are going to be having a discussion about how they view and define ESG, the ever-changing regulatory landscape and the opportunities this is creating, and also provide some color on some interesting themes and areas of interest in the space today. Before we start, I'll provide brief introductions to Juliette and Arnaud for those of you that haven't met them, and then we can dive in. So Juliette is the director and chair of the ESG committee at Atos Alternative Management. She has more than 15 years of investment research experience and has been involved in launching and managing 2 ESG dedicated fund of funds. Juliette, thanks for joining us today. Arnaud is the lead portfolio manager of the TerreNeuve strategy, which is a long-short strategy focused on sustainability. Arnaud has been focused on sustainable research for almost 20 years and has been running his strategy on the buy side for the last 13 years. Arnaud, thanks for joining us.
Thank you, Shannon. Thank you everyone for being on this call.
So before we dive in, I just want to point out that we do have time reserved at the end for Q&A. I'm sure most of you are familiar with how to use Q&A on Zoom, but if you click the button at the bottom of the screen, submit any questions, we'll make sure to cover those at the end of the discussion. All right, so now on to the fun part. So I think, Juliette, to start, it's helpful to just maybe set the stage for the audience. So Atos recently launched an ESG dedicated fund of funds, and I know that Atos has a long history and focus on sustainability and ESG. So can you maybe provide some context on how you define ESG, what has led Atos to build the business with this as such a focus, and then also, given your experience in the space, touch on how you've seen client interest evolve over time?
Great, thank you, Shannon. And thank you everyone for joining us. I'm excited to be here to have this discussion. I hope you find it interesting and insightful. In terms of the questions that you asked, Shannon, so I'll just go, I think it's a 3-part question: how we define ESG, how clients' interest has evolved, and Atos' evolution as well in the ESG space. How we define ESG, we think about ESG really as a tool that managers use to make better investment decisions in terms of identifying alpha opportunities or managing the risk of their portfolios. And the way we typically see managers do this is in two key ways. We have the sustainable theme managers. Think about managers focusing on things like the energy transition, the circular economy, healthcare. And then we have those that would look at just about anything else, but think about material ESG risk and opportunities in their investment process. And in general, these managers are also excluding or not investing in certain areas, sectors or companies that have either stranded asset risk, regulatory or tail risk, or even in terms of their values. And examples of that will be things like tobacco, firearms, or fossil fuels. Moving on to the second part of the question in terms of how clients' interest has evolved. I've been looking at ESG for almost a decade now, and I would say it's almost night and day. In terms of client interest, it's almost fair to say ESG is now almost mainstream. If you think about it, it feels like we're in a place where all the different stakeholders have significant interest in the space. When you think about customers, companies, investors, and the regulatory body, there is significant interest pulling up from each of these. And that's driven by a wide variety of factors that include things like the realities of what we're experiencing today with climate change, and then certainly COVID that has exposed a lot of some of the concerns around us in things like human capital management, and in the US, the racial issues as well. And just the significant availability of data that dispels some of the misconceptions that if you integrate ESG, you have to give up returns. some examples of how we are seeing we're seeing this in the asset flows, right? If you look at mutual funds specifically, I was looking at a recent Morgan Stanley data around this. This year, you have an average of about 50 billion in assets flowing into ESG mutual funds globally on average every month for this year. And that's compared to about 20 billion last year a month and a lot less before that. And again, just focusing on mutual funds only, that inflows over the past 12 months is 8 times that into traditional mutual funds. So the money is flowing into the space. And then the last thing I'll say about client interest is the focus is not just on the products anymore. So now you're seeing the managers and the firms themselves are being put under a microscope, right? So investors not only want the ESG products, the firms, they're asking questions about how you're thinking about climate change as a firm, how you're thinking about issues like diversity, equity, and inclusion. So moving on to the third part of the question, which is how the business at Atos has evolved around ESG. I would say that ESG has been a core part of the Atos business since our founding almost 20 years ago. It's something that's that our founders, Ann Cassels and Michael Klein, are very personally passionate about, and that's the way they used to build the business around issues about culture and diversity, equity, and inclusion are a key part of the culture at Atos. 70% of the employees are considered diverse. Anne used to run the Stanford Endowment Program, which was 10 billion in assets, and 1 billion of that was the responsible investment program at Stanford. So that kind of thinking has flowed through. We have a long history of engaging our managers on ESG issues. For example, Anne has engaged distressed managers that had nothing to do with ESG on their coal assets over the last 10 years, so why they still continue to hold coal given the regulatory headwind and just where we are going in terms of climate. Over the years, the last couple of years, we're now integrating ESG into our investment process. We have a ranking system across the board for all managers on their ESG integration. In 2018, we became a UNPRI signatory. And then, like Shannon mentioned earlier, at the beginning of the year, we launched a sustainable focus strategy. So that's a little background on Atos and our thinking on ESG. To start a discussion, I know maybe it'll be helpful for the audience to get a sense of how you define ESG as well.
All right, well, thank you, Juliette. Thank you, Shannon, for this great introduction. And thank you, everyone, for being on this call again. So, I mean, for us, sustainability investing is not a box-ticking exercise, or it's not about greenwashing or compliance. Simply based on a few exclusions or third-party rating systems. Of course, with TerreNeuve, we do have exclusion policies, and we have developed over the last 8 years a proprietary rating system, which is, I think, truly unique in terms of bringing to the party fundamental due diligence tool. But deep inside our excitement and our conviction really comes from this view that companies which we define as sustainability leaders are entering a period of sustained outperformance versus sustainability laggards. So the objective of the TerreNeuve strategy is very clear. We want to invest and support what we call sustainability leaders, companies which, through their products and services, offer some solutions to the most pressing environmental and social issues, with the short side basically of the portfolio being the mirror image of that, with a significant attention to pay to governance, accounting, or tax issues for that matter.
Great, thank you for that introduction. So let's dive into the discussion and conversation. maybe onto something that's very topical today, at least in the US. Priorities in Europe and the US are very different around ESG and sustainability. In Europe, climate change is definitely the key focus. In the US, climate change is also a key focus, but increasingly the S part of the equation is becoming a significant focus, specifically diversity, equity, and inclusion. So I'll start with that. How do you think about diversity, equity, and inclusion at Lombardo DA, specifically for your team and in the context of the companies in which you invest in the portfolio?
Well, first of all, I must say I'm proud to be associated with a firm that is focused on diversity, equity, and inclusion. At LOIM, we have actually a steering committee focused on D&I, and we have identified 4 pillars around recruitment, advancement, culture, and operational change as areas where we can create positive change. As a firm, we aim to deliver an employee experience that attracts, develops, and retains diverse talent to achieve superior results for our investors, businesses, and communities. More specifically for on my team, we have a plan for expansion that accounts for my views on the fact that diversity is a critical element to our future success. And we basically plan to enact, this plan as the team grows. Additionally, and importantly, social and D&I considerations have been core to our research efforts and capital deployment for many years. We've been at the forefront of research on obesity, health and nutrition for many years, but we've also written over the last 3 years about the opioid addiction crisis, access to healthcare, academic research distribution models, access to education, but also things like seed crop pricing, crop protection, health-related issues, and so on. And actually, we published last night a white paper on the gig economy and workers' rights, with a strong focus on the food delivery industry. This is not a marginal sector. We're looking at a combined market cap of over $100 billion. And in this paper, we argue that a significant portion of the increased offer to the consumer in the food delivery sector is the result not so much of great technical leaps, but rather the undercompensation of the workforce. Effectively, the gig workers who are treated as contractors rather than employees. And effectively, the willingness of investors to tolerate losses over a multi-year horizon. So de facto, in that paper, we've taken a negative view on the sector, arguing that the market fails to understand the evolution of legislation and case law, but also the social conscience and politics regarding the status of gig workers, which in our view would result in high costs for platforms and material earnings disappointment going forward. In addition, I don't want to spoil the party for people who will enjoy reading the paper, but we talk also about the fact that, after forced lockdowns, which have boosted the food deliveries bargaining power, we think, short-term gains will be eroded by competition or by policymakers, or simply a return to normalcy post-COVID pandemic. Also highlight, the extent to which the sector could suffer from consumer backlash, given its negative environmental footprint. So quite a different way of looking at the sector. Maybe, what about you, Juliette? How do you think about DE&I at Atos?
Yeah, absolutely. And before I jump into that, I encourage everyone to read that the white paper that came out last night. It's really very interesting and gives a different perspective, especially around the S issues on food delivery sector globally. At ATO's, diversity and equity and inclusion is very much a key part of our DNA and how we think as a firm and as a culture. For the sustainability focused product strategy that we launched earlier this year is also a key theme, as well as climate change from the top down. 40% of the managers, or just about 40% of the managers in that fund are diverse portfolio managers, and something that we are looking to continue to improve upon. And for the rest of the managers, we are mostly focused on managers like I know who are thinking very carefully through these issues at the company level, but also at their firm level as well. And we have an engagement program to keep that conversation going with managers on this issue. So it's very much a key part of what we do in our sustainability fund and at the firm as well. So speaking of engagement, a key part of your investment due diligence process is meeting with company executives on a very consistent basis. How are you engaging these companies on ESG issues as you meet with them? What's the conversation like?
So to give you a sense of our work, I mean, as a team of 3, we do around 700 company meetings annually. And I can assure you there isn't a meeting where ESG is not a consideration. Now to elaborate, I guess there are various gradients in our engagement on ESG matters. I would spare you the traditional Q&A session we have with all companies, which always touch on environmental, social, or governance matters, because, you know, from our perspective, ESG matters are deeply connected to business anyway. Maybe instead, I share with you a couple of examples to give you a feel for how far we go in terms of our engagement. And maybe I'll just group these, these into 3 categories. The first category is really engagement at the top level. As ESG and sector experts, we have been invited a few times to present and discuss our views with executive committees of large corporates. For example, we've helped a leading European chemicals company define ESG targets and benchmark their performance on multiple parameters. That's, just an example, but we've been very heavily involved discussing at the highest level how companies can actually get better, not only at just communicating with investors, but effectively delivering the goods, because it's not about greenwashing, it's really about doing the right things. The second category is really around governance. Although you will never see our names in the press, as we can favor engagement behind closed doors to noisy activism. We've been fairly active over the last 9 months, engaging with boards on top management teams on major governance matters, including CEO succession issues or M&A situation. The third category is really related to the financing of emerging businesses related to sustainability. Over the last 3 years, we have actually developed an expertise in emerging industries like hydrogen, energy storage, or green chemistry that is now widely recognized by financial institutions looking at bringing companies to market. That gives us, we think, a nice competitive advantage in terms of looking at the deals, but we also take very seriously our responsibility of potentially vetting business model or even sometimes technologies. For example, early this year, we were approached to look at a chemicals recycling startup at a very early stage. They needed financing to build a plant. Basically, we studied technologies, spoke to potential off-takers, did proper due diligence. I was very detailed, but in the end, we didn't get involved, but recommended other solutions to get the project going. And we are still in touch with the management team.
That's great. At ATO's engagement as well, we consider our investments with managers a partnership. And like I mentioned earlier, have a long history of engaging with managers for the sustainability focused strategy. We also have a dedicated engagement program where we do our own ESG analysis on the company and engage with managers on any key findings on that and potentially with the companies as well. So switching gears a little bit on the regulatory front, there's a lot happening there globally. In the last 12 months, we've had several new policies in Europe specifically, but in the US and even in Asia. Can you maybe start with Europe, where we have some pretty significant regulation in terms of the European Green Deal and taxonomy. So can you comment on what that means from an investment perspective?
Well, maybe I'll just start with a short intro to put that in context. I mean, in such a fast-paced environment, it is sometimes difficult to step back and reflect on what has just happened. I'm sure, you know, all of us on this webinar today and anywhere around the globe could probably agree on at least one thing. I mean, the last 18 months have been extraordinary. Extraordinary times to live through a pandemic, lockdowns, working from home while homeschooling or taking care of others, but also an extraordinary recession leading to unprecedented economic contraction and mass unemployment. And now, or coming soon, I think an extraordinary reopening characterized by shortages and revenge consumption, we think. We also have to acknowledge that the response of governments and central banks to the pandemic, you know, have been extraordinary and will undoubtedly have a long-lasting macro impact. The key point being the reintroduction of Keynesian-style fiscal stimulus coming on top of loose monetary policies. So, okay, over the summer 2020, we discussed in a white paper and a series of webcasts our view about the European Green Deal and the EU taxonomy, which we called game changers for the economy and sustainability investing. In that white paper, we explained that fiscal stimulus placing sustainability, the environment at the heart of their projects would have a tremendous impact on a number of clearly identified sectors. And that the advent of the EU taxonomy, which is the EU's attempt to define sustainability investing, would generate significant flows towards these sectors. It's probably important to remind here that the ultimate objective of the EU Green Deal is to help reduce emissions by 50% in 2030 and make Europe carbon neutral in 2050. Together, there are 5 major pillars: make buildings energy more efficient, increase the share of renewable energies, develop a green hydrogen economy, accelerate the shift to clean mobility, develop a circular economy. Now, looking at the year-to-date performance of some of the sectors, you could be forgiven to think that this was a one-off investment last year and we are all done with it. Now, the reality is that we are just starting to see capital deployed by EU countries. And I think, you know, this is just kickstarting a 10-year investment cycle that will support the long-term outperformance of key beneficiaries of the Green Deal. So we see investment opportunities as being plenty at this point in time. To take a very concrete example, we estimate that for the EU to reach its objective of having at least 30% of its energy consumption from renewable sources by 2030, it requires more than 300 billion euros of investment. And that's before we think about all other costs related to grid improvements, storage, and so on and so forth. So we think that, you know, financial markets at this point in time can't see the wood from the tree. The question in the renewable energy space right now is not so much competition, higher cost or potentially higher interest rates. To us, the question is, are there enough operators capable of delivering the gigantic pipeline of projects required to meet targets by 2030. So that makes us extremely bullish on the sector in the renewable energy space in particular, and the entire renewable value chain. Net, we remain extremely bullish on the EU Green Deal as a thematic driver of performance in Europe. It's probably fair to say that about 2/3 of our European exposure for TerreNeuve is aligned with the Green Deal objectives and more broadly the EU taxonomy.
Great. So yes, a lot going there to think about. And moving on to the US, where a key part of President Biden's agenda is also climate and economic equal access to economic equality. He recently also had the Earth Day with several leaders, with the follow-up coming up in November, and then we have the infrastructure plan. How are you thinking about that as well from an investment perspective? What are the opportunities there?
Yeah, I mean, thankfully, when it comes to sustainability, the story is not just about Europe. It's clear there is, at this point, a strong momentum to adopt more progressive environmental and social policies around the globe. And the election of Joe Biden was, from that perspective, and many others, I must say, another game changer in 2020 for the years ahead. Rejoining the Paris Agreement and committing to net zero emission by 2050 was a must for the US, which I think will give a new impetus to the COP21 objectives. Holding a leader summit on Earth Day in April was very smart. I think it was a way for the US to say, we're back and we want to drive the global sustainability agenda. And personally, I think that's right. The world needs the US and needs the US to see the US using its leadership on these matters. At the domestic level, as I'm sure you've all seen, the Biden administration introduced in March a $2 trillion infrastructure plan called the American Jobs Plan. The plan is currently being discussed and negotiated with the Republicans with a view to make this a bipartisan bill. The final number and the scope may change somewhat, but the key point is that this is a very big plan. This is a very ambitious, not just economic, but socio-economic plan that go well beyond infrastructure to include public transport modernization, a massive EV plan, but also grid improvement, renewable energy, green technologies, housing renovation, and a massive tax reform, which I think will also change a lot of things for the US. So from an investment perspective, I'd say like a bit like in Europe, a stock had the initial move ahead and upon announcement, but since then some names have stalled or retraced because investors tend to be a bit impatient, and that's probably a good thing, as it suggests there is still plenty of upside potential. But at the end of the day, we are looking here again at a 5 to 10 year investment cycle. This is a once in a generation project, which I think is going to have dramatic implications across sectors. And we think, we are well positioned to capture that.
So have you been taking advantage of some of the dislocation we're seeing this year to find attractive opportunities?
Well, there's not been a lack of dislocation so far this year. After basically a fourth quarter of 2020, when we saw the world waking up to the opportunities created by the Green Deal, the election of Joe Biden, that led to a real pop in the green space, whether it be green tech, renewable energy, and basically industries of the future that will help decarbonize our society. We've seen a bit of a pullback, notably in the clean energy space. What is remarkable here is to see that many of the stocks have actually on a relative basis come back to where they were in the first quarter of 2020, which is kind of extraordinary considering how much good news we have seen and we've had for the last couple of quarters. So yes, we've been basically rebuilding and probably growing our exposure to the notably the renewable energy space, where, as I said before, we are extremely positive. In green tech, I think it's the situation is a bit more complex. There are some really fantastic assets out there. We've been very selective in our approach, and we are actually very confident with the investments we've made in the space, seeing a lot of option value effectively in the companies we own. So, we remain more bullish than ever, basically, on the opportunities created by regulatory changes, and I think right now is a great time to get involved in the space.
Great. So let's talk about some of the themes we're seeing today. For our sustainability strategy at Atos, we are looking at looking for very high conviction managers and portfolios where we can create a very diversified portfolio, similar to a flagship strategy that is fossil fuel free, but very diversified in terms of themes. Like I mentioned before, we have a key component of climate and diversity, equity, and inclusion, but outside of that, we look to create something that was diversified by sector, market cap, and even factors such as value and growth. And in various ESG themes as well, such as the energy transition, the circular economy, healthcare. So can we talk about, you are involved with quite a number of these themes in very different ways. And I would like you to tell the audience about some of the themes that you mentioned some before as we're talking about the regulation, but maybe dig a little deeper on some of the themes you're excited about.
Sure. I think for many of you maybe on that call who've heard me before, I won't rehash what I've been saying for the last 3 years about hydrogen. That's a sector on which we remain extremely bullish. We've seen a bit of a correction lately in pure play related to the hydrogen economy, but we remain, long-term extremely bullish. But I won't focus on that today. I thought, we should probably talk about the circular economy, because it's probably one of the most fascinating and hottest themes, and one where we've been building considerable exposure to. To be clear on the definition of a circular economy, this is actually here we're talking about an economic system aimed at eliminating waste and the continual use of resources. In essence, it's about sharing, it's about reusing, it's about recycling what we produce and extract from the ground. So when you think about it, it's kind of the holy grail for anyone pursuing a sustainability agenda. We started to write about the circular economy about 3 years ago. Our initial work was very much focused on the future of packaging. The starting point of our work was to acknowledge that single-use plastic items face tremendous and growing regulatory and demand headwinds, and that alternatives should benefit. So our approach on that theme specifically, and almost in line with what we always do, was to dissect and analyze the value chains to identify key technologies, competition, margin structure, and value added. And our key conclusion specifically on packaging was, well, we think the polyethylene industry, think oil and gas crackers, which has been adding capacity at a rate of 3 to 4% per annum, will be extremely challenging in the next 10 years and is going to be squeezed. Therefore, we want to be sure that we think the flexible plastic packaging maker, we think will disappoint in the many years ahead, and we want to be sure that sector. When it comes to a single-use plastic packaging specialist, we also probably want to avoid that part of the market. But on the other hand, we think that there's clearly a great future for recycled plastic, which is going to boom. And we've built exposure to some specialists which actually collect, recycle, or even some companies which produce non-oil-based plastics from sugar, producing polylactic acid. And we also think that basically paper-based packaging is going to take share from plastic going ahead. Last but not least, we think of forest as the most probably underrated assets. And that's an area where we've been systematically long for the last couple of years. Now, our exposure to the sector has grown quite markedly over the last 3 years. We've done more work on let's say other parts of the circular economy, to include a number of businesses involved in recycling. So we have actually now a pretty diversified portfolio to a number of leading and emerging recyclers. So to be specific, we have exposure to textile recyclers, which we think are going to be winners, given the substantial attention paid by the consumer to where and how textiles are being made. We have exposure to chemicals recycling, we have exposure to metal recycling, we have exposure to battery recycling. We think this is an area where we've seen extraordinary development in terms of technology, and where we think we are going to see very strong growth, and we feel very comfortable with the business models. Last but not least, I probably need to talk about actually waste management and water. We think, you know, the sector, which very often tends to be associated to basic utilities, is actually going to be re-rated as increasingly is going to be regarded as a growth sector. We see waste management as actually playing a growing role in the circular economy. And we see, obviously, the protection of water, one of our most valuable assets, as a key driver of sustainability going forward. So, you know, we could spend hours talking about the circular economy, but we think right now this is probably one of the most exciting themes where we're going to see very strong growth with very exciting new business models coming to the market.
Great, thank you. I think Shannon is joining us again.
Yeah, so yes, I think I want to make sure we have time for some questions. So we've had a few that came in. So if anyone has any other questions, please feel free to submit them through the Q&A box. So to start, it looks like, so Juliette, I think this one's for you. So at Atos, are your managers impact and ESG exclusively, or do you also consider managers where their underlying strategy and focus naturally lends itself to something like health and well-being?
Yeah, I would say in the sustainability strategy, the managers that either impact or ESG, they think about ESG in some form or another way. But if the strategy does lend itself to health and well-being, and the manager is open to continue to consider ESG risk and opportunities as part of that, then we're certainly open to it as well.
Perfect. Okay, next question.
A key part of our process is also the engagement program. So, you know, like I mentioned before, for us, it's very much a partnership, and we have to be comfortable that the manager is open to engaging and having those conversations around ESG as well.
Perfect. All right, next question. So for Arnaud, I guess there's two questions that are kind of similar, so I can tie them together. So do you believe that shorting a low ESG rated company is sustainable?
So the question around shorting and whether it is actually puts us in compliance with an ESG mandate has been around for many years, but we've been, clear advocate that there's a role for shorting, and we think, we take very seriously our role as a hedge fund promoting and the concept of sustainability. And we've spoken quite frequently about actually the role that hedge funds can play in driving a sustainability agenda in the asset management industry. So we do believe actually there's a role for shorting. We think actually shorting companies with a low ESG rating, can make sense. For us, it's never going to be the sole criteria in terms of making an investment decision. As much as we like to talk about themes, or as much as we like to talk about the long-term ideas, we are first and foremost stock pickers, and we need, as stars to align whenever we make an investment decision. So, ESG is always a consideration, but as much as valuation is never the only reason you invest in a business, well, ESG is never going to be the only reason you short a stock. The valuation, argument has to be there. The earnings have to be there. We need to see catalysts. We need to see technicals working in our favor. So shorting has never been an easy exercise, and but we remain convinced that actually there's a role to play. But there's a role also for ESG managers, in the hedge fund industry to engage with corporates. I'm not saying that you can be out there promoting your short through the press and then look like a hero and have proper conversations with management. That's not the way to do it. But I think you can be short a company, you can actually engage with management, and if things improve, you will just close your short. So I've no actually issue and no second thought about actually us being short stocks. We think once again, shorts have a role to play, and clearly the objective of the strategy is eventually to deliver returns. And we think the idea for us is to identify for any given theme the winners and the losers. From that perspective, I do think that once again, shorts have a role to play. Almost as I explained, about the on the packaging sector, we think basically it's going to be just hard for the polyethylene industry to deliver and impress the market in the years ahead when there's just so much headwind from a demand perspective and from a regulatory perspective.
Perfect. Okay, great. We have, I think, 2 more questions in case anyone wants to submit any more, but I want to be cognizant of time as well. So another one for Juliette. So as an allocator, when you're diligencing managers for the sustainability fund, how have you been able to really distinguish between managers that are truly integrating and between managers that are more so greenwashing? And have you found any tools that help with that?
I would say the best tool is a deep research bench that we have at ACOS. And frankly, the way we've been able to distinguish is just really digging into the investment process. Our due diligence process is very iterative. We meet quite, as you know, we meet quite a number of times with managers, with the portfolio managers, with the analysts. We sit in and evaluate the tools. I've been to your offices, I've seen your models and your rating systems and how that's integrated into your investment process. So it's just that it's easy to get a presentation that talks about ESG. For us, it's really digging into the process with multiple meetings, with multiple people, and just really developing that conviction that ESG is really integrated and part of that investment decision-making process. So there is no magic bullet,
no tools.
unfortunately.
You haven't found any ways to just get there super quickly.
Right, but I will say in terms of the third-party system, we do use we use the MSCI ESG ratings as a starting point for ESG analysis on the portfolios in our ESG strategy. So of course, if half the portfolio is rated very poorly, then there's a problem. But it's a very useful starting point for us to have additional discussions with our managers and dig a little deeper to the extent that we see anything that's material. And we don't always agree with the ratings, as you know, but it's helpful. It's a helpful tool to do additional analysis and have those conversations.
Perfect, thanks. Okay, and last question for Arnaud, which Arnaud, you did kind of touch on this, but I think, earlier this year, the question was earlier this year, people were concerned about the green tech bubble, and we've since seen a correction. You kind of touched on this, but how are you think about that in terms of positioning, and what are your expectations for that kind of going forward?
Yeah, sure. Well, I mean, I think there's been a bit of an obsession about the green bubble. I mean, I think the green bubble probably happened for 1 quarter. I would probably argue that there are many other bubbles to be concerned about in this market at this point in time. So I know that a lot of people probably missed the train or do not really understand what's going on in this, basically these new segments of the economy. People who don't like the challenge of actually progressive policies are probably at this point in time, naysayers about green and whatever, progress, is going to happen. So look, I mean, I think it was probably sound to see a bit of a correction in the first quarter of this year, given probably the excess we had in the fourth quarter. I didn't like very much the fact that it continued in the second quarter, let's be honest. But let's put it this way, I think the bulk of the correction from a standpoint has already happened. And I think, very often people tend to get confused about sustainability. They just think that sustainability equals expensive. We disagree profoundly with that. We have been actually buying stocks which we think are at the forefront of the sustainability revolution, which are actually trading on very cheap multiples. And we think their ability to re-rate from here remains intact. Not to mention that, quite a number of names in the utility space have become very cheap again. I realize that interest rates going up is not necessarily going to be good news, but I would argue that in consumer discretionary, interest rates going up is probably not good news either. So there are ways for us basically to put the portfolio together that is actually hedged and that take into account the factor risks related to maybe rates going up, long rates going up, and still deliver performance in the quarters and years ahead. So, in summary, I think we've seen probably we've seen a sound correction. We think there are plenty of opportunities at this point in time, and once again, it's not as if sustainability had to be expensive. We think actually there are plenty of really attractive stock right here, right now to add in portfolios.
Perfect. Okay, great. So I think that is it. Arnaud, Juliette, thank you both for taking the time to speak with us today. And thank you everyone for joining. And we will be in touch soon. Feel free to reach out with any questions, or if you'd like to review the white papers that Juliette and Arnaud mentioned as well. Thanks.
Thank you.
Thank you, everyone. Thank you, Juliette. Thank you, Shannon.